Right. Let's dive straight into this explainer and set up what is essentially the ultimate showdown in equipment financing for growing businesses. Whether you're a construction firm eyeing a brand new fleet of dozers, a manufacturer looking to upgrade an entire assembly line, or even an IT director rolling out new server infrastructure, you are eventually going to need capital. And that brings us to a massive fundamental choice in exactly how you fund that growth.
So this is the absolute classic dilemma faced by SME owners and contractors when they need to acquire heavy machinery or software. Looking at the data, everybody seems to be asking the exact same question. Which is better? Do I go to my traditional commercial bank and try to lock down a loan, or do I use the vendor's in-house financing or maybe a private equipment lender? I mean, it feels like a super simple A or B choice, right? But here is the fascinating twist, our sources point out. Actually, comparing these as just better or worse is fundamentally flawed. These aren't just two slight variations of the exact same product. No, they're entirely different business models, built on completely different risk profiles. So the question isn't really which one is better overall. The real question you should be asking is, which business model does your specific, immediate situation actually belong in?
Okay, moving to section 1, the equipment financing dilemma. To start things off, we really need a complete paradigm shift in how we view these two distinct approaches. Let's just wipe the slate clean and understand the core mechanics of what's happening behind the scenes when you ask for money.
First up, we need to clearly define vendor financing. And keep in mind, this broadly includes private equipment lenders and manufacturer finance programs. Basically, instead of paying the full capital expenditure upfront and totally draining your working capital, you pay in installments. This can take a few forms, like an operating lease where you're essentially just paying for usage, a capital lease where you buy the asset at the end, or a secured equipment loan. It's often offered right there at the point of sale, by the manufacturer, or through an independent private leasing company that partners up with them.
And to really wrap your head around the sheer scale of vendor financing, get a load of this. We are talking about a staggering $400 billion industry in Canada alone back in 2018. That absolutely proves this is a mainstream tool, not some shady back alley option. I mean, that massive number makes private asset-based finance the largest provider of debt financing in the country, right behind traditional banks and credit unions. I really want to highlight this, because sometimes the term private lender makes people picture an unregulated fringe operation. But the reality is the exact opposite. In fact, over 70% of B2B buyers prefer financing equipment purchases rather than paying for the whole shebang up front.
Let's jump to section 2, banks betting on you. Now we're going to unpack the traditional banking model and how their underwriting process actually works in the real world. Okay, so the absolute crucial point here is that while banks do offer the lowest headline rates, they operate by betting heavily on your pristine financial history. When you apply for a bank loan, your file gets bounced around through analysts and credit committees. They usually want to see a credit score of 680 or higher. They want 2+ years of consistently profitable tax returns. They are intensely scrutinizing your net income and your personal credit. And crucially, to secure that super low rate, they frequently demand a general lien on your overall business assets or a personal guarantee. Because their capital is so cheap, their underwriting is highly selective, which means the process is undeniably slow. We're often talking several weeks here. All right, section 3, vendors, betting on the machine. Let's totally contrast the bank's approach with how private lenders and vendor finance companies operate. They look at the world through an entirely different lens. With this model, the vendor is actually lending against the machine itself. They care about its resale value and its lifespan rather than demanding years of perfect tax returns from you. Because they specialize in these specific assets, they intimately understand the maintenance schedules, the brand reliability, and exactly what they can resell a used bulldozer or a dental chair or a server rack for. And because of that, they can approve a much wider band of credit scores, sometimes dipping right down into the 500s. They'll consider startups. They often only need a few recent bank statements instead of heavily audited financials. The equipment is the primary collateral, so you usually aren't pledging your house or your other business assets. And the absolute best part, they can often fund your purchase in just a few business days. This brilliantly illustrates the core thesis we're getting at today. Banks are betting on the jockey while vendors are betting on the horse. And that fundamentally changes exactly who they say yes to and how fast they say it. The bank looks at you, your track record, and your financials, with the machine really just serving as a backup in case things go horribly wrong. The private lender, though, looks at the inherent value of the machine first, with you as the backup. This huge difference in risk modeling dictates absolutely everything downstream. Section 4, the total cost trap.
let's shift our focus from that super alluring headline interest rate to the actual real-world cost of your money. We all see the paper reality first, right? Banks typically boast a lower interest rate, say 8%, compared to a private lender's 11%. So say you're borrowing $150,000 over 5 years. That 3% gap, it translates to roughly $12,000 in extra interest. On the surface, the bank seems like the undisputed, totally obvious winner. Honestly, why would any rational business owner willingly pay an extra $12,000 for their equipment?
Well, here's the catch. Look at how bank fees and the lost revenue from those slow, multi-week approvals can literally instantly erase those paper interest savings. A bank might charge appraisal, documentation, and commitment fees that shrink that $12,000 gap right out of the gate. But the real killer here is time. Think about it. If you win a $30,000 contract but you lose it entirely because the bank took 5 weeks to approve your equipment loan, your savings have completely vanished. Poof. Furthermore, those 5 weeks of downtime were weeks that new equipment could have been billable. Suddenly, that 11% vendor rate, which gets the machine onto your site and working in 3 days, is far more profitable.
I should also mention a really interesting middle ground here. For Canadian buyers, the BDC sits comfortably right between banks and private lenders in terms of both speed and cost. As a federal crown corporation, they offer rates closer to bank grade, but with some of the awesome flexibility of a private lender. Like, they can finance up to 125% of the purchase price to cover freight and training, and they even offer interest-only payments while a machine ramps up. Approval typically takes about 10 to 30 days. It is a fantastic middle lane if you don't need the machine tomorrow, but you want more flexibility than a traditional chartered bank is going to give you.
Finally, Section 5, choosing your winning strategy. Let's dive into an actionable playbook that maps real-world business situations to the exact right financing tool.
Okay, so if you've got the time and a flawless financial track record, sticking with a traditional bank loan is absolutely the smartest, most profitable move for sure. If your credit score is north of 700, you have strong, profitable returns, and you're buying brand new equipment directly from an authorized dealer, the bank is your absolute best friend. This is especially true on large-scale amounts. If you're financing $500,000 or more worth of core fleet machinery that you're going to run for years, a few percentage points of interest saves you massive amounts of cash over the long haul. In that case, absolutely go with the bank.
However, if you are staring down a time-sensitive contract, maybe you have slightly bruised credit, or you're buying used iron, vendor finance is your agile solution. Say you need a skid steer next week to start a municipal job, a bank simply cannot move that fast. Or if your business is only 14 months old but pulling in really strong monthly revenue, the vendor lender will look at your bank statements and fund you today, whereas the bank is going to demand 2 full years of tax returns. Or hey, what if you're buying a 2014 excavator with 6,000 hours on it? Banks generally shy away from older assets, but private lenders know exactly what that machine is worth, and they'll gladly finance it for you.
You know, the really smart operators out there don't just pick one. They actually build a hybrid financial toolkit to optimize their cash flow and scale dynamically. They use the bank for their primary long-term assets, with that low-interest compound savings over time. But when they spot an incredible deal on a piece of used equipment or a surprise contract just lands in their lap, they use vendor finance to seize the opportunity immediately without tying up their other credit lines. And remember this pro tip. You can always use a private lender to build your credit history for 12 to 18 months and then just refinance the deal back to a traditional bank once your financials are looking pristine again.
I'm going to leave you with this provocative thought to chew on. Is your pursuit of the lowest rate actually costing you the deal? Stop chasing paper savings, evaluate your real-world costs, and choose the financial tool that actually builds your business. The costliest mistake you can possibly make is burning 4 weeks applying at a bank just to secure an 8% rate, only to get declined or completely lose the job, when a vendor finance partner could have had your equipment running and generating real revenue in a matter of days. Evaluate your total opportunity cost, pick the right lane for your specific deal, and keep growing.